Hello and welcome to the AI Fairs podcast. We are diving deep today into really the burning question that underpins every investment thesis right now. Is the AI boom a genuine transformative revolution? Or is it simply the biggest speculative bubble since the dot-com crash of 2000 just waiting to pop?
Right.
I mean, we're talking about valuations that have hit trillion-dollar marks, and a lot of it feels like it's based on future hype.
And the stakes couldn't be clearer or, frankly, more terrifying. Back when the dot-com collapse unfolded, it wiped out about, what, $3.6 trillion from the NASDAQ? Our analysis suggests that if a similar percentage value decimation, we're talking roughly 78%, were to begin today, we could be looking at subtracting an ultimate $40 trillion from the NASDAQ's market cap.
40 trillion. I mean, a number that big forces us to move past the hype and look strictly at the fundamentals.
It has to.
So our mission here is to analyze the source material, the raw numbers from VCs, analysts, tech firms, and tell you exactly where the economic models hold up and, where the valuation is pure speculative froth.
Let's start by looking at the shadows of the past, specifically the alarming parallels that have reappeared in the current market structure.
The single loudest echo from 2000 to me is the relentless piling up of debt for infrastructure that may or may not be needed. We saw this with WorldCom, with Lucent. What are you seeing in the source material that suggests we're repeating that whole debt debacle today?
The echoes are deafening. Back then, the bust involved $500 billion borrowed, mainly to lay fiber that ended up sitting, 85 to 95% unused.
Just sitting there, dark.
Exactly. Today, the scale of debt is just eclipsing that. AI data center capital expenditure, or CapEx, is forecast to hit $2 trillion by 2028.
$2 trillion. And crucially, where is that $2 trillion coming from? It's not just cash on hand.
No, not at all. According to Morgan Stanley, a staggering $1.5 trillion of that CapEx is forecast to come from debt. And that includes high-cost private credit deals. The fact that even these massive cash-rich companies are relying so heavily on expensive external financing, it just highlights the intense strain this build-out is placing on corporate balance sheets.
And this strain, it leads us directly to the most toxic parallel with 2000, something we call the circular financing shell game. It mirrors Lucent's vendor financing disaster.
It's exactly the same pattern.
We're watching suppliers essentially fund the customers who then turn around and, well, buy their products.
And this specific financing pattern is what triggered the collapse of so many of those late 90s players. I mean, Lucent offered $15 billion in vendor financing right before it just imploded.
So where do we see that today?
Look at the ecosystem. NVIDIA, the hardware supplier, has invested $100 billion into OpenAI.
Which OpenAI then uses to buy.
To buy NVIDIA chips, of course.
And the risks don't stop there, right? This is a house of cards built on these interconnected partnerships.
It is. You have the cloud provider CoreWeave, which gets an estimated 60% of its revenue from OpenAI.
60%.
And at the same time, Oracle is reportedly already losing $100 million every single quarter on its data center rentals to OpenAI, despite their massive deal. It's an incredibly intertwined high-risk system.
Which makes OpenAI the trigger.
It makes OpenAI the single most critical risk trigger right now. We have to monitor their cash flow intensely. Sources indicate OpenAI needs to reach $125 billion in revenue just to break even.
Just to break even.
And that milestone isn't anticipated until 2029. Until then, they are financing a massive loss, a current $14 billion annual cash burn.
That kind of cash burn, it just underscores the volatility. It was already alarming when their CFO publicly sought, assurances or guarantees from the U.S. government for their debt.
Right, and Sam Altman walked that back so fast.
He had to. But it signals a real fragility in securing the capital they need to keep this whole build-out going.
Exactly. And it raises the core question. If the financing patterns, the debt load, and the vendor shell game look just like 2000, what evidence do we have that this time is actually different?
That's the crucial counterargument, because if this were just 2000 all over again, the crash would probably already be underway. So let's start with a valuation sanity check. The market feels exuberant, but are the underlying valuation multiples as truly insane as they were back then?
They are not. That is the first major difference. The NASDAQ 100 forward price-to-earnings ratio hit an astonishing 60.1 at its peak in March 2000.
60 times forward earnings.
Yeah. Today's AI-driven NASDAQ PE, while high, is significantly more moderate. It's sitting at roughly 26.4 as of late 2023.
Okay, but 26.4 is still historically expensive. If we are risking a $40 trillion wipeout, saying it's merely half as expensive as the last crash doesn't exactly calm my nerves, the real difference must be in the quality of the companies.
It is. And that's the second and I think most vital structural difference. In 2000, only about 14% of dot-com companies were profitable.
Yes, 14%.
Today's leading AI firms, NVIDIA, Microsoft, Google, these are established profitable machines. Look at NVIDIA. They hold a 53% net profit margin, supported by verifiable bookings and backlog. We aren't talking about some speculative company trying to figure out a business model.
No, we're talking about massive profit generators. And the tech itself isn't a luxury anymore. It's already embedded everywhere.
The adoption data is really compelling on that front. By 2024, 78% of companies globally report using some form of AI.
So it's not like the early internet.
No, which lacked that broad business integration. AI is foundational. It's structural. It suggests that even if valuations dip, the underlying technological shift is here to stay.
And who is driving that spending is also fundamentally different. We aren't relying on thousands of speculative IPOs to raise capital for infrastructure this time.
Precisely. The enormous capex is primarily being driven by the hyperscalers, Microsoft, Amazon, and Alphabet. These companies have huge free cash flow and immensely strong balance sheets. They are managing the supply ramp themselves.
Which gives the industry better visibility.
Much better supply and demand visibility than the chaotic, fragmented market of 2000.
So we have a tale of two markets. Profitable giants on one side, and on the other, we're calling the unicorn paradox. This is where the extreme bubble behavior is hidden today, in the private company valuations. What are the capital flows telling us about where money is concentrating?
The concentration is breathtaking. In early 2025, 58% of all global VC funding went to AI startups.
58%.
To put that in perspective, that is an unprecedented asymmetry. Even compared to the peak concentration of capital back in 1999, this intense, narrow focus has created some surreal valuations.
And the most shocking metric in the sources relates to how little actual staffing is supporting these billion-dollar price tags.
The valuation per employee is truly astonishing. Some of these AI startups are valued at $400 million to $1.2 billion per employee.
Per employee.
There is no historical dot-com parallel for that kind of metric. When you see companies like OpenAI, valued anywhere from $80 billion to $300 billion with relatively minor current revenues, it is evident these valuations are based purely on a future outcome, not current anything.
And that expectation is running headfirst into the reality check of corporate implementation. An MIT study found what they called the Gen AI divide. What did that study reveal about enterprise ROI?
Their finding was startling. 95% of enterprise generative AI pilot projects fail to yield a return on investment.
95%.
And they never make it into scale production. This failure rate is the gap between the venture capital hype and the practical business reality.
So why are companies, even with all the tools available, failing so miserably at turning a pilot into a real production system?
There are three main reasons. First, there's a technical gap. Only 5% of customized solutions are actually reaching scale production. Second, the learning gap. The systems often lack memory and feedback loops, meaning they keep repeating the same expensive mistakes. They're useful the first week, but then the errors just start to mount.
And the third reason, that one complicates our ability to even measure this value at all.
It does. It's the phenomenon some analysts are calling shadow AI or Schattenwirtschaft in German.
Shadow AI.
This is the informal use of private tools like ChatGPT by employees, which is hugely effective, but it happens outside the official IT budget. And because this value is off the books, official company ROI measurements look artificially terrible, which further complicates the decision to invest more.
This leaves us exactly where we started, in a mixed market where over half, 54% of global fund managers label AI stocks as being in bubble territory, even while NVIDIA is thriving. So what are the future scenarios we need to prepare for?
I think we have three clear possibilities. The most optimistic, but still cautious, is the soft landing. I give that a 35% probability.
A soft landing, what does that look like?
This involves valuations declining moderately, say 60 to 70% over 2 to 3 years, but without a panic. It's cushioned by the continued strong earnings from big players like Microsoft and Google, who hold the profitable infrastructure.
Okay, so what about the financial catastrophe everyone is whispering about?
That is the OpenAI bankruptcy cascade. We're giving that a 25% probability.
And that starts with?
It starts with OpenAI failing to secure the enormous capital needed to cover its burn rate. That triggers a chain reaction. CoreWeave, which relies on OpenAI for 60% of its revenue, goes bankrupt. NVIDIA takes a massive write-down on its investment. Investor confidence just collapses, leading to a recession and a potential 20 to 30% decline in the S&P 500.
And the outcome that validates all this investment.
That's the continued boom. We see a 40% probability for that. In this scenario, companies successfully overcome that 95% pilot failure rate. They implement AI for genuine efficiency gains and growth, causing revenue to surge, and finally validating these ambitious valuations we see today.
So for you listening, what are the concrete, actionable indicators you should be tracking right now to judge which path we are actually on?
You have to watch the key points of financial stress. First, track OpenAI's revenue growth versus its enormous cash burn rate. That's number one. Second, monitor changes in VC funding velocity. If it drops substantially below that recent $192.7 billion record, that signals drying capital.
And what about the concentration risk, even in the profitable players?
Absolutely. Watch NVIDIA's customer concentration risk. Sources report 40% of its revenue comes from just two mystery customers.
Two customers.
A single point of failure that could be fatal if either of those customers defaults or shifts strategy. And finally, keep a close watch on CoreWeave's ability to cover its substantial $11.2 billion debt load.
How bad is that situation?
Last quarter, CoreWeave reportedly spent over $250 million just paying interest on that debt, while generating only $19 million in operating income. That ratio is just, it's not sustainable.
So that brings us to our final conclusion. We are operating in a market with genuine technological transformation mixed with classic speculative froth. We see the clear bubble hallmarks in the $1.5 trillion forecast in debt for CapEx and 58% of all VC funding flowing into this one narrow sector.
But these financial dynamics are contrasted by the fact that core AI is demonstrably foundational, and the major players, the hyperscalers, the chip makers, are deeply profitable. So while AI is a genuine technological supercycle, the valuation and financing components are absolutely operating under bubble-like dynamics.
So what does this all mean for you, the individual trying to disaggregate all this risk?
The true risk, I think, lies in the short-term mismatch. Cloud giants are planning to spend a combined $240 billion in 2025 alone on AI infrastructure.
$240 billion.
But the immediate AI services are only expected to bring in about 10% of that spending. You have to disaggregate the data to decide who is building enduring, profitable value, the established infrastructure giants, and who is simply riding speculative excess, the unicorn valuations, and that circular financing shell game.
Thank you for listening, and see you next time on AI Affairs.